So, you have Warren Buffett, right? Probably the greatest investor of all time. And then you've got Bitcoin, this incredibly disruptive financial technology from the last decade. So, why does the master of investing absolutely hate it? Today, we're unpacking one of the most fascinating standoffs in modern finance.
And it really all boils down to this one infamous quote. Back in 2018, Warren Buffett didn't just dismiss Bitcoin, he used some of the most brutal language you can imagine. I mean, rat poison squared. That's not just dismissive, that's intense. It was a declaration of war.
And that's really the big question we're tackling today. Was this some deep, analytical conclusion, or was it more of a gut rejection from an investor whose legendary playbook was written for a totally different world? To get to the bottom of it, we need to look at the man, his methods, and the moment he said it.
All right, here's the game plan. We're going to start by digging into that whole rat poison thing. Then we're going to get inside Buffett's head, understand his worldview and why he said it. After that, we'll bring in the counterargument from some other heavy hitters in finance. We'll see exactly how these two frameworks collide, and then finally, we'll ask the big question. How has that verdict aged?
Okay, so let's kick things off by putting that famous line in context. Because believe me, the when and the where are just as important as the what. So the scene is the 2018 Berkshire Hathaway annual meeting. Picture it. Bitcoin had just gotten hammered, crashing about 50% from its all-time high. It was trading just under 10 grand. And his longtime partner, Charlie Munger, went even further. I mean, he called it dementia and talked about people trading turds. Seriously, this wasn't some calm, reasoned debate. It was right in the middle of a crypto panic.
All right, but to really get why they'd say something like that, you have to look past the insult and get into Buffett's core philosophy. This is his blueprint, right? He spent decades perfecting it, and the key to the whole thing is consistency.
And at the absolute heart of that blueprint is this idea he calls the circle of competence. Buffett's rule is dead simple. If he can't understand a business inside and out, if he can't analyze it with total confidence, he just doesn't touch it. End of story. It's the discipline that's made him billions.
And this is a brilliant way to see how he organizes the entire investing universe in his mind. He sees just three buckets. Bucket number one, productive assets. Think businesses, farms, real estate, stuff that actually generates cash or food or rent. Bucket two, non-productive assets. Gold, fine art. They just kind of sit there hoping someone else will pay more for them later. And bucket three is just currencies. For him, all the action, all the real value is in bucket number one.
So, and this is the absolute key. Where does Bitcoin fit? For Buffett, it's a slam dunk into bucket number two. It's a non-productive asset. It doesn't have earnings. It doesn't pay you a dividend. It doesn't build anything. He's famously said he wouldn't pay $25 for all the Bitcoin in the world because, from his point of view, what's it going to do? Nothing.
Okay, but here's where it gets really interesting. Because while Buffett sees this useless digital token, you've got this whole other class of brilliant, world-class investors who look at the exact same thing and see something completely different.
Let's start with a legend, macro investor Paul Tudor Jones. See, he doesn't look at Bitcoin and ask, what's the cash flow? He looks at the global economy, at all the money central banks are printing, and he asks the different question. How the heck do I protect my wealth from being inflated away? So for him, Bitcoin's not a company, it's a lifeboat.
And then you've got Ray Dalio, founder of Bridgewater, another titan of the industry. He was a skeptic at first, but he came around. When he says something like cash is trash, he's talking about a world where interest rates are basically zero and governments are just printing money like there's no tomorrow. In that world, holding cash means you're guaranteed to lose purchasing power.
You see, these guys are playing a different game entirely. They're looking through a totally different lens. They don't give a hoot about earnings reports. For them, the value is in Bitcoin's design. There will only ever be 21 million. It's verifiably scarce. So it's not a business, it's basically an insurance policy against the value of regular money, dollars and euros, going down over time because so much of it is being created. And this right here is the heart of the whole debate. It's not just two people disagreeing on Bitcoin. It's two completely different and very successful ways of looking at the world colliding head-on.
Let's put them side by side. It makes it super clear. On one side, you've got Buffett's value investing. It is laser-focused on one thing. Cash flow and earnings. The job of an asset is to be a productive engine. Then you've got the macro folks like Dalio and Jones. They don't care about earnings. They're focused on scarcity and what we call network effects. the idea that it gets more valuable as more people join the network. Its job isn't to produce cash, its job is to be portfolio insurance. They're just playing completely different sports, with different rules and different ways of keeping score.
So that's the setup. The big question is, who was right? Or maybe, which framework has been a better guide since 2018? Let's fast forward and see what actually happened in the real world after Buffett made that famous comment.
Well, since that day in 2018, a lot has changed. First, you had major public companies like MicroStrategy and even Tesla putting Bitcoin on their balance sheets. That was a huge deal. And then came the real earthquake. In early 2024, the US regulators finally approved spot Bitcoin ETFs, basically opening the door for massive mainstream investment.
And of course, the price tells a pretty dramatic story. So when Buffett called it rat poison squared, the price was hovering just under $10,000. Fast forward a few years, and it's trading around 70,000. That's a 7x increase. The market clearly voted with its dollars, even while one of its heroes was warning everyone to stay away.
So where does that leave us? What's the final verdict here? Look, Buffett's view makes perfect sense if you stay inside his framework. The thing is, his framework was built for the industrial age. It's designed to value companies that make things and sell them. It just doesn't have a tool, a category, for something whose entire value proposition is based on a digital, mathematical guarantee of scarcity. He didn't really analyze Bitcoin. He just saw it didn't fit in any of his boxes and rejected it outright.
And that leaves us with this really fascinating final thought. Warren Buffett became a legend because he so disciplinedly stays inside his circle of competence. But what happens when the world invents something so new, so different, that that circle starts to feel less like a fortress and more like a cage? When a totally new paradigm comes along, how do you know when to stick to the rules that made you successful and when it's time to admit you need a whole new map?